Microsoft closing their stores, Disney delaying their reopening, the stock market falling, unemployment and virus cases increasing, the real estate market getting affected, last week Nike earnings report, and next week Fedex earnings report. We have a lot of things to talk about in this video, so let's get started. But first, I have finally decided to open my Discord chat completely free, of course, for any of you that might be interested in investing or just chat with me and other members in the group. I will be posting the link to the group in Tuesday's video since I'm setting everything up right now. But let me know in the comment section below if you have any idea for the group or what you would like to see in it. Also, please subscribe if you enjoy my videos and smash that like button since it really helped me out a lot. Okay, so a decade ago, Microsoft started opening retail stores to expand their business to retail presence and create shopping experience similar to what Apple was already doing. Last week, they announced that they were going to close all of their 83 retail stores, focusing only on online retail. This will result in a $450 million charge for assets write-offs and impairments. After I read this news, I was wondering what was going to happen with those employees, and they said that they will help on the website instead of in-store. So all of them are given the opportunity to stay working for Microsoft. So now Microsoft will be putting all their time and money in online presence since their digital stores like Microsoft.com, Xbox.com, and Windows reaches more than 1.2 billion people on a monthly basis. I think that investors will actually like this news because this could mean a reduction of expenses for the company. Also, the Vice President David Portner said that the sales have actually grown online as their product portfolio has evolved to larger digital offerings. In my opinion, they might have noticed during these 2 months of quarantine that their monthly sales grew even more and that their retail stores were not actually that effective as it happens with Apple. Now, Disney. We all know that they already reopened their theme parks in Shanghai back in May. But what has happened with all their theme parks around the world and hotels? Disneyland California postponed reopening until they receive approval from government officials, since the state of California has now indicated that it will not issue any theme park reopening guidelines until after July 4th. Here in Florida, they are supposed to reopen on July 11th, but their workers are urging Disney and government officials to reconsider opening Disney World next month due to an increase in coronavirus cases here in Florida. The thing is that theme parks are very, very important for Disney since it is their second biggest source of income, as well as their movies, and the movie theaters are still closed as well. Still, they have had a lot of success with Disney Plus since a lot of people have been opening new accounts since quarantine started. Even though their biggest source of income is media network, which includes broadcast, cable, radio, publishing, and digital businesses, their second and third source of income are parks and studio entertainment, which are almost 45% of their revenue, meaning that they might be having a huge loss every single day their parks are closed. Next, an important thing to understand is why the stock market has fallen a lot the last week. First, the virus cases just continue increasing. As you can see, in the US, we are at all-time high. Here in Florida, we have had more than 9,500 cases in a single day. Yes, it's right, deaths are decreasing, but the latest huge increase in cases could lead to a huge increase in deaths as well. And why does this affect the stock market? I have always said that people were being too optimistic about the situation, and seeing the stock market so overvalued meant for me that any good news were already priced in. The truth is that right now, people or investors are scared of what will happen to companies if they have to close their stores again. Will they survive? Will they see an increase in companies' bankruptcies? Also, unemployment numbers could increase, and what will the Fed do with that? Will they give more stimulus? So there's so much uncertainty that is finally being reflected in the stock market. Another reason for why this downtrend has started is the current company's valuation. A lot of stocks or companies are way overvalued right now, and a lot of people have noticed that meaning that they might be taking profits, driving the stock market down. Also, there's a wave of selling estimated to be in billions that is about to hit the stock market. What does this mean? Analysts are expecting investors, pensions, and funds to start selling their stocks to buy bonds. Why? The quarter is almost over and all these pensions and funds tend to do a rebalance at the end of the quarter, meaning that if they are used to have 50% of their money in stocks and 50% of their money in bonds, but because of this uptrend they have way more money invested in stocks than in bonds, then they will rebalance at the end of the quarter and buy more bonds by selling part of their profits in stocks. This could definitely lead to a lot of volatility by the end of this second quarter, which is ending this month. Obviously, there is a chance that this could not happen and will not affect the market at all, but we have to take into consideration that this could happen and will lead to a major downtrend. Also, 1.48 million Americans filed for unemployment benefits during the last week ending in June 20th, making it the second week with US jobless claims worse than expected. If the virus cases continue increasing and stores, companies, restaurants, and malls have to close again, unemployment numbers could see a huge increase in the coming weeks. The last thing that could be affecting the stock market at this moment are the elections. This year is election year and Wall Street executives brace for potential Biden win as Trump faces in polls. This is one of the reasons, mainly because investors are afraid of the Biden tax proposal plan, which includes a change in corporate tax from a single corporate tax of 21%, which is what Trump implemented, to 28%. And obviously investors do not like any increase in corporate taxes, since that would affect directly to every single company's profit. Also, because of all that, treasury bonds have been affected as well. Last week I mentioned that the 10 and 30 years treasury bonds were at its all-time low. Right now, the 10-year treasury bonds fell to 0.64%. The 30-year to 1.38%, and 5-year treasury note to 0.29%. How does this affect us? Well, it affects us in a good way if you would like to refinance your house or take out a new loan, since this directly impacts the fixed rate mortgages. Normally, if the yield rises, banks and other lenders start charging more interest for mortgages. Basically, right now, lower interest rates make housing more affordable for people. Now, the real estate market. When the pandemic started and unemployment increased, a regulation was created protecting tenants from evictions, meaning that if a person could not pay their rent, they would not get evicted during those months, but could pay it after all this ended, depending on what they agree with their landlord. Because of that, homeowners could also apply for forbearance, so they would be able to not pay for their mortgages during those months either. What is the problem? That the rental eviction freeze is expiring soon and US is facing an avalanche of evictions. We can also start seeing an increasing in foreclosures, since 4.3 million people missed their May mortgages payments. Also, because of the pandemic and people not being able to pay their mortgages, 47% of homeowners are considering selling their houses before they start struggling even more economically speaking and end up facing foreclosure. That could lead to a huge decrease in houses price. In the commercial real estate side, we are seeing a lot of problems as well. Analysts are expecting 25,000 stores to close in 2020, which 50 to 60% of those are situated in American malls. Stores like Neiman Marcus, Stage Stores, J. Crew, and JCPenney have already filed for bankruptcy protection, meaning that a lot of them will have to close some or a lot of their stores. So far right now, we have 900 stores closed from Pier 1, roughly 300 stores from GNC, and way more companies like Tuesday Morning and Victoria's Secret. Now, last week I gave you guys my predictions for Nike earnings report, so let's analyze those earnings and then I'll give you my predictions for next week's earnings report. Nike reported a revenue decrease of 38% in comparison to the same quarter last year, and a net loss of $790 million, which was not expected at all. I said that I expected a huge decrease but not a loss, so apparently their online revenue was not enough to cover their losses from closed stores. they had an increase in inventory of almost 27%, which their sales were not enough to cover, leading the company to have a huge loss. And you would ask, why did that happen if their online sales actually increased 75%? Well, as always, online sales do have smaller profit margins for companies because they have to include packaging, shipping, and complex logistics process and more. Basically, their profits margin was 37.3%, down from 45.5% of last year. Now, a lot of companies will be reporting earnings next week, but for this video, I will be analyzing Fedex. At the beginning of the pandemic, we saw a huge increase in online shopping, and companies like Fedex could benefit a lot from the situation. The thing that concerns me is that normally these delivery companies have peak season in Q4 of each year and they prepare months ahead, meaning that they were not prepared at all for a huge increase at this moment, and most probably they needed to pay overtime to drivers and employees and also rent more trucks as they normally do in peak season, spending a lot of money. For this quarter, I can see an increase in revenue due to the huge increase in e-commerce, but might not see a huge increase in profits as a lot of people is expecting because of the amount of money they needed to spend to be able to meet the demand. Hope you enjoyed this video. Don't forget to subscribe, smash the like button for the YouTube algorithm. Thank you and see you next time.